What is working capital? Working capital is dealing with the short-term current assets and current liability. So how a company is planning and forecasting its working capital will be discussed here. So working capital management includes all short-term liabilities and assets, that is current liabilities and current assets. So how to manage liquidity, how accounts receivable or accounts payable or stock or short-term loans or cash in hand, all these things, how we are a company is managing. So there are 6 steps involved in forecasting of working capital requirements. So each of these steps is being detailed and listed below. First one, uh, organization has to collect the following information that affect the working capital requirements. First one is, what is the expected production during the year? After estimating the expected production in units and in the year, expected cost should be ascertained. First, they will ascertain the direct cost, that is cost of raw materials, cost of labor, and cost of overheads per unit of production. Then, various things to be considered is how much time the raw material will be remaining in the store, that is in stock, before it is issued to production process. Then, how much is the length of the production process, that is how much time it takes for the raw materials to be converted into finished product. That time will be taken into consideration. Then the period during which finished product will be remaining in the warehouse. So raw materials period will be considered, the time taken for work in progress or conversion period, and then finished goods, how much time it will be there in the warehouse also will be considered. Then the period of credit allowed to debtors for credit sales. That is, if credit sales are happening, how much time a company will be giving to its debtors. Then period allowed by creditors for credit purchase of raw materials. That is, if a company is purchasing materials on credit, how much time will the creditors give us? Then the time lag in payment of wages and overhead, the inclusion of profit element in the debtors, the nature of production and overhead accruing throughout the year. So this is the first step. So the second step is determining the average estimated production. That is per week or per fortnight, once in 2 weeks or months, how much is the estimated production. And the third one is to determine the average expected cost, that also either weekly, fortnightly or monthly, of each element of cost, that is especially direct cost, direct material, direct labor and overheads. Then determining the net block period for each element of cost, that is how much is the block period for material, labor and overhead. Take an example that in a firm, raw material may be there in the store for 2 months. The time to convert raw material into finished goods may be 1 month processing. Finished goods will be remaining in the store maybe for 2 months. Maybe in the hands of debtors, that is till we get money, maybe 4 months. And is usually paid for 1 month after credit purchase. So these many time lag is there. So the net block period will be 9 minus 1. That is 1 month for credit purchase. So it is 8 months. Then the period during which fund for raw material will be remaining blocked will be this 8 months. The next step is we have already calculated the net block period for each element of cost with their average periodical cost separately. So this will give the working capital requirement for each element of cost. We can take an example, continuing the previous one. If the net block period of material is 8 months, we have already seen that, and monthly cost of raw material is 10,000 means the total working capital for material alone will be 8 into 10,000, that is 80,000. In this way, working capital for wages and overheads has to be separately found out and to be tallied off. So lastly, add the item-wise working capital requirement as found out in 5 to arrive as the total working capital required. So total working capital will be the sum total of direct material, labor and overhead charges. Thank you.